River Capital Management managed to grow during the recession and after, something a lot of other firms were unable to do. I'm here with Colin Teicholz, who is a partner and co-head of fixed income. Hi, Colin. Thanks for coming over here today.
Thanks for having me.
So tell us a little bit about how you guys were able to grow during and after the recession when so many other places were unable to.
Well, our strategy is really focused on finding mistakes in markets, and
sounds fun.
It can be for sure, and especially the 2008 financial markets meltdown was challenging for us as it was for many. But it created all kinds of mistakes across markets. We took advantage of as many of those as possible. We particularly focused on the mortgage market, which is a gigantic market, $10 trillion, but had been really overcapitalized prior to the crisis, Fannie Mae and Freddie Mac and others. And just as risk was exploding in the mortgage market, capital went running away. Fannie and Freddie had to step back. Private sector investors were selling mortgages, not buying them. And so for our relative value trading strategy, we found lots of mispriced securities and we're able to benefit from that. And we do that globally across all kinds of markets.
Fantastic. And you guys are now a $14 billion firm, so grown quite a bit. I'm wondering now, with so much regulation and that's changed how banks are investing, what opportunities does that leave hedge funds and investment firms like you guys?
Well, it's a very challenging environment for banks, and one of the things that's been interesting to me while I've been here is I've been able to talk to many of the people at the big banks and hear about how they're adapting their business plans and their strategies to the new regulatory and capital framework, and I think they're doing great work on that. But one of the side effects of that is that they're going to be taking a lot less risk in many markets.
Good for you guys.
And so that creates opportunities for us. We can partner with those banks, and they've got great distribution and access to a lot of opportunities. Those are opportunities that in some cases the banks would have kept in their own proprietary trading desks. But in this environment, they'll work with hedge funds like us and other investors, and we can take advantage of that. So we're excited by that for our business. And it's good to hear, as we've talked to senior executives at some of the big banks, that they are making those adjustments, and I think moving forward.
Definitely, and it leaves some opening. I know before we were talking a little bit about emerging markets and credit. Seems like that's something you guys are looking forward to getting even more active in this coming year.
Yeah, well, certainly one of the themes here is that broadly speaking, I think there's more optimism that we're hearing from everybody at Davos. In emerging markets in particular, there is a lot of volatility. It's getting, there's certainly a lot of activity even in markets just in the last 24 hours, in Latin America, in Turkey, in China, et cetera. Just as in the mortgage market in years past, that type of volatility created opportunities, we're beginning to look more at emerging markets opportunities in currencies and in credit, looking for mistakes in those markets, and as there's more volatility, there'll probably be more of those mistakes.
So we'll be keeping an eye on that. Colin, thank you so much for joining us again.
Thank you for having me.